Johanna says we're scared to work it. Yeah, it could. Thanks. Yeah, I got disconnected for a moment. I'm just checking out this FedEx. They announced earnings and stocks about unchanged. It's been up 10, down 10, stocks about unchanged. So I took a little piece of that, and they just announced earnings, and it's pretty well flat. John, thank you, as always, for being a loyal supporter and member. I think I've struggled with a cohesive message this week. Thanks, Sel, for hanging around on these webinar series, and hopefully you're getting some value. Well, as I was saying, I've been struggling with a cohesive message just because of the nature of the craziness of the markets. I'm trying to communicate a lot of nuanced thoughts, and it's not always easy. So Greg Perry says, hey, I just signed up to the elite program. I'm very excited to be joining the team. Thank you. So Greg, thank you. And welcome to the Pattern Trader family, and hope you get a lot of value out of it. But thanks for signing up. All right, why don't I get cracking then? So welcome to the last of our 4-day live trade execution webinar series subtitled How to Capitalize on Monster Moves in the Markets. My name is Mark Shaws and the Pattern Trader. So all this week, I've been sharing how to evaluate and analyze the markets only using price information. So we certainly have a world today where we are bombarded with so much information. You know, we have rampant inflation. Will it continue? Is it transitory? How long will it stay? How big will it grow? What will the Fed's response be? We have this awful humanitarian crisis in the Ukraine. Will it expand? Will NATO get involved? Will it be World War III? On and on. And there's a big mistake in trying to digest all this and think we can come up with some cogent way of, you know, putting this all together and then applying it, you know, to the market. Certainly if you're using leverage, if you're trading FX or you're trading short-term on the stock market. You know, one thing's to be a Warren Buffett style investor where you buy a railroad company and you stick it in your portfolio and you watch it every 3 years. You know, we're trying to make moves, you know, in terms of, you know, taking out pieces of the market. Now, yesterday, we had a meeting, the Federal Reserve, and afterwards, the US Fed Chair, Jerome Powell, gave his comments. And it was, you know, I kind of was listening with one ear in the background while I was looking at my charts. And it's, you know, usually a mistake to try and get that information and think about it. And then it infuses or affects your objectivity. So to my mind, the most effective trader has to be completely objective. And if you're looking at price, then necessarily you're trying to, you know, not let news or other external things influence you. And that, in today's world where we've got TV and we got crawls and we got, you know, our phones, and we're bombarded and overloaded with information. And to me, you know, you have to be completely objective, and especially in today's market environment. You know, it was one thing, you know, 2019 to, you know, for 18 months, the markets went straight up. You could hop on board a trend and, you know, that trend would basically take you. Now it's very much a trading market and a stock picker's market. It's not like, you know, one size fits all where a rising tide is going to raise all ships and, you know, just make a bet and, you know, hope the market will take you on its merry way. Now, you know, if you listen to, and the thing is, the market is a discounting phenomenon. So since last November, when the stock markets peaked out, the market, the NASDAQ has gone down 21%. So yesterday, so I'm just pulling up this live chart of the triple Qs, and you can see it peaked out at like 410 and dropped to about, you know, 310. So about a 25% move in the NASDAQ, you know, from November till now, March. In the last 4 months, we've gone down 25%. And then yesterday, you had extremely hawkish comments from Jerome Powell saying that he was going to intervene. Effectively, he said he's going to raise interest rates 11 times between now and next year. Now, he left himself a lot of wiggle room, saying that it was going to be a jump ball and that every meeting they were going to make a determination whether they were going to go at that meeting, go bigger, go harder, what have you. And he also said he's going to reduce the balance sheet. And if you listen to all of that, you'd say, whoa, the markets must be coming apart. But if you look at, you know, the markets this week, we've gone straight up. And so it's counterintuitive. You know, why is that? You know, when, you know, the Fed is now saying they're going to be, you know, full on raising interest rates. And yet the stock market, you know, has gone straight up this week. And so this is why it's very difficult and contrary to your financial health to trade on, you know, the news. So you can see we've gone straight up from 310 to 344 on the triple Qs. I should use the NASDAQ chart to put in NASDAQ terms, but this is an ETF that basically just approximates the NASDAQ. And so I've been struggling with a cohesive theme to talk about. You know, typically I show you a pattern And then to my mind, a pattern correlates to a movement. And then from that movement, I try and extract a piece out of that. And for the last 4 months, I've been telling our members, I've been very bearish based on prevailing patterns in the NASDAQ, where we've seen what looks like a double top. This looks like an M top pattern. And so to my mind, based on what I perceived as a top, I've been shorting all kinds of NASDAQ stocks for the last 4 months and, making a lot of money doing so. But the markets throw you a lot of looks where you got to, I always look at, okay, what is the governing trend or, pattern that is directing traffic that is going to lead to the next move where I can just take a piece of the middle out of that move. And so right now you kind of have a market that's topped, but also a market that's found an incredible amount of support. And so now we're in this nether area where you've got to choose where, which pattern, which price action is directing the next movement. And that's why it's been, and you've been getting these 5-6% per day movements up and down in the markets. So basically, what I look at is a pattern, and then I look at how does the market trade within that pattern. Meaning that if I see, so we also have what appears to be a double top and a head and shoulders, where you kind of see the left shoulder here. This is the peak, and this can be construed as the right shoulder. And then we have this neckline that basically comes in through here. So what I have learned through many decades of trading is that you see these patterns in a textbook, and then the market should do that. So my expectation is once I see a pattern, and a head and shoulders is inherently a bear pattern. It indicates a move that ostensibly has topped. Leading up to here, we've gone here, we've made this pattern, and now what we should see is this. But what always alerts me, if the market's pattern does one thing, and this should have gone this way, but you can see it went that way. And so that, is always a red flag. And so it's a real struggle for me on these presentations for me to kind of cogently, explain these very nuanced things. But at the end of the day, I'm really struggling to find a way to explain how if one thing doesn't happen, it's going to do the other thing. So, many times we see these patterns, and then, if the price action doesn't do what the pattern says, then by virtue of this doing something else is called a busted price pattern. Now, I'm not quite ready to throw in the towel and say that this is busted. You can see that we've come to a very tricky downtrend line. We basically penetrated, but on the face value of it, this is quite a turnaround where you found this bottom right along, this trend, so you can see markets hit certain areas. And when they do so, they don't just, cut through those areas like a knife through butter. So we popped here. And now the question is this just a rally in a bear market? Or is this something that's going to lead to something more sustainable? And for me, I think it's probably going to be somewhere in between where, we may not go up, we may not go down, and we could just, do a lot of sideways type trading. But, ultimately it comes down to risk and reward. And, what I do is I keep an eye on the patterns and the price action, meaning that when I see certain types of price action, you can see here, this made a new low and closed on the high. it made a new low and close on the high. So whenever you kind of revisit these areas, it becomes very tricky. You don't just slice through them, and you can see this bounce right off. And now this apparently looks like it's going to close on the high also. Now, here's the important thing. It's Thursday. This is a weekly chart, and this bar where you see this little slash mark to the right, that will denote where the market closes. Now, right now, it looks like, we've got two closes, the double bottom and two closes right at the high. But, it's going to be very important where this thing closes tomorrow. I mean, if we close down here, it's going to have a very different look than if it's closing here. So to me, I look at how a market closes relative to the high and low. And based on how it closes, at certain areas, it tells me that ostensibly there are certain supports. So now this is a huge juggling act in my mind. And this is why I've been so reticent to kind of, because there's an inherent conflict, where you have a pattern and a trend one way, and yet you have some very formidable price action suggesting that you've dug in and you could be ready to go the other way. And so the market is very dynamic and fluid. And we have to be able to objectively react to that, not think about what Powell said, because what Powell said is, on the face of it, very bearish for stocks. So, when the stocks were going up, you had the Fed at your back. You had the tailwinds. Now you are going to be fighting the Fed. You're going to have the Fed as headwinds. They're going to be in the markets raising rates, taking, taking money off the balance sheets. And those things typically are not friendly to certainly stocks in the NASDAQ, these growth stocks. But the thing is, this has already anticipated a lot of that bearishness. So the market has already done a lot of the work for the Fed. The Fed wanted to slow things down. They wanted to, crunch demand down to, stamp out inflation. And so they started jawboning in November, and the market started anticipating what, Powell was going to say yesterday, 3 months ago. So the market is anticipatory. It's a discounting, and it's already done that work. So now whatever kind of goes forward is, somewhat discounted. And then the market likes transparency. So there was a lot of uncertainty through this. Now the market has a plan that the Fed has laid out. And for right now, it's put a bid under here. And so it looks like for now, there's a whole bunch of stocks that are going to run. And so ultimately, it comes down to risk and reward. So one thing is looking at the indexes. The other thing is, I trade individual stocks also. So sometimes I'll trade the indexes if I think there's just going to be an overall market thing. Mostly I trade individual stocks because irrespective of, what's going on with the market, I'm just looking for risk and reward opportunities. Now, here are my positions that, I've kind of gone on today. I'm long FedEx. I'm long PayPal. I told you, about this when I bought around 100. And today, I think it crossed 112. And then I started buying some Uber. And, I'll kind of explain why I did that. And then I'm, likely long the dollar versus the yen. And the yen just hit a 6-year low. And I think that, that's likely to be a good trade in the currency markets. So the thing is, I apologize for this screen. I changed screens yesterday and all these icons flip to this screen. So again, I'm trying to figure a way to, because there are just many cross currents. On one hand, the big picture says that, to my mind, the stock market ultimately is going to go lower, but in the intermediate term or the short term, you're likely to get a whole bunch of a bounce in a whole bunch of stocks. Now today I took a nibble at Uber. And not the greatest trade. I don't feel tremendous about it, but what I try and do is find risk and reward relationships. So to me, it all starts with a trend or a pattern. So when I look at a chart like this, I mean, it's a little counterintuitive because if I look at this, I'll say, well, of course, this is a downtrend. But trends do change. And when they change with a pattern where, people say, well, how'd the market go there? And then it's up there. And typically before it's up there, it puts on a pattern that we can anticipate that change in direction. Now, the change is, right here, you have this double bottom where just like it sounds, market goes to a low, it bounces off a low, retests the low, and now we basically just slightly crossed this neckline. The neckline is simply a line that is drawn through the pattern. So we have this double bottom here, which suggests that with the word bottom in it, prices are on, are going to be heading higher. Now, sometimes you see these things, they look like something, and, even here, there was a bottom here. You could have taken this thing and taken a nice ride, and then it went right back into the trend again. But, here's the thing. So it's a combination of, a pattern and also price action. So we have this pattern. And then today we had this, mostly inside bar, where most of this range is within, it snuck out the high and closed above the neckline. And so typically what I will do when I, see a pattern and then, what I call this insurance day bar, or either this key reversal or this inside bar, is that I will then layer it, with an execution plan that says, look, I'm going to put a buy stop above today's high and let it confirm it. Because, tomorrow we could, open and go straight down. And so, by buying it on the close, I didn't wait for that confirmation. Typically, I advise, our members to see the action, put your buy stop, and then let the market confirm it. Now, whether this is turning or not, whether this is going to be a good trade or not, is that I can start seeing a risk reward relationship in my mind where I'm anticipating a turn. We have this coil, this inside bar. And now basically I bought it here at 32 and, I'll put my stop at 31 and I'll risk $2, to make whatever, $10. And so, this may work, it may not work, but, I'm risking $2 to kind of check it out. And so, what I also see on this chart is that I look for a combination of a pattern and then price action. And what do I mean by price action? So you can see that this guy right here, when this made an all-time new low, it actually closed on the high. So it's what I call a key reversal, where just what it sounds like. So what I look at every day is the relationship. How does the market close relative to the high and low? So if, we're in a downtrend and the market makes a new high and then close on the low, I'm assuming that that thing's pointing that we're going to go lower. When it makes a new high and close on the low, especially on a huge range like that, that usually indicates you're going to go lower. So when this thing was drilling down, I was looking for all of these bars to get me in the cadence of this downtrend. Now I'm surmising that this trend is going to change by virtue of an emerging pattern and then a series of price action. So you can see that we have this key reverse. And again, let me just explain. So a key reversal is just simply observing the relationship of the close. So this little slash mark that we see here, that indicates where the market closes. And by closing on closer to the high of the day, that indicates that the buyers were in control. So what this says to me was that earlier in the day, the sellers came in, tried to drill this thing. By the end of the day, we went the other way and closed there. So ultimately, while this thing tried to go lower, the buyers were in control. Now, I don't just look at this key reversal in a vacuum. I look at it together with, a number of things, whether it's a support area, a pattern, what have you. And what I notice is that this thing has been trying to make a bottom for a while. You'll see that here was a key reversal, made a new low, close on the high, made a new low, close on the high, made a new low, close on the high. So you can see buyers were starting to come in and test this thing. And then finally, this thing just came in and I think made this capitulation and made this low. And I think that this is going to work out to be a good risk reward trade. And if it doesn't work out, I'm going to lose $2. And believe me, my life will go on. And so this is what I'm trying to do on an ongoing basis, is find pockets. I don't care what Powell said. I don't care where the market's going to go. I'm trying to find pockets of risk and reward where I can find. And what I like to do is get things early where, you catch the shoot, the horse right as it's about to come out of the barn, where, you get it on the turn. By the time this thing's up here and you're trying to buy it here, there's a whole different risk reward relationship. So if I can catch this thing early, by definition, my risk is going to be relatively small and my reward is going to be relatively large if it works out. And so I took a nibble at this and, we'll see what happens. You can see that there was also, so I look at a combination of key reversals and inside bars. So once I see a pattern, then I wait for a bar that actually, that I can set up a risk reward relationship. So here was, and I'll do something very early where I'll see this and say, okay, we're at this double bottom. Now we've got this price action where I've got this little inside bar and I can literally put my buy stop, above the high of this day right here. My stop right there. And so this will be my risk and, who knows what the outcome will be. And to me, it's all about if you can get in a trade and understand your risk, where this is going to go, how it's going to get there, that part I don't know. But what I do know is that I, feel like I'm getting in at an area where I'm going to know very quickly whether I'm right or wrong. And if I'm wrong, I'm not going to risk a whole lot. So that's Uber. What else did I told you about PayPal the other day. I bought PayPal the other day. Not a classic buying pattern, but again, I think this is a market where, all of these stocks have been so beaten up. And now we have this, we understand what the Fed is saying. And so there's a chance that the market's going to have a relief rally. And so you can see now with PayPal, we're in this area where it's, grabbing a foothold. And it could very easily come out of here and, go up, this thing could go up 20% and, you wouldn't even notice it. This thing's dropped from $320 to $90 in a straight line. So now, the market's got this, bit of a bottom going on here. And so I think the dogs will start to run, the Twilios and the Rokus and the stocks that have gone down 80%, very easy for these things to have a 20, 30% relief rally, before they go back into the trend. So, not a perfect thing because this thing can, come right back down. But, I got this thing right as, it was breaking out. I told you about this on Monday or Tuesday. And to me, I had almost no risk in my mind. This is one of those trades where, in my mind, I kind of, when I'm doing it, I feel like it's a riskless trade. So I bought this in the night market when it closed right here on the high. I bought this at $100.50. and now you're, $12 higher, and you're kind of right into this little resistance level. But you can start seeing that there is a pattern here, this kind of Adam and Eve double bottom. So, an Adam is characterized by just a single attempt at a low, and then here you have kind of a multiple attempt. But you have what appears to be a bottom. And so this is what I look for. I look for patterns, and patterns then translate into direction. And then I'm simply just trying to take a piece out of the move from that direction. And you can see now, we've kind of had 3 straight up days now. If we get kind of a move up tomorrow, I'll probably, start taking some, taking some off. Although I think that you could have a pretty good move out of here. I mean, there's an arbitrary downtrend line that comes in right around here. And so to me, this would be nothing for PayPal to go back to 130, maybe even attempt to get back into this huge gap here. So I think that the risk reward, and again, this is about risk and reward. So it doesn't matter if I think this is a bear market rally, if I don't know how long it's going to last, and I can do all of those machinations. I'm trying to drill down to areas where I can understand risk and reward. So Casey says, what is the difference between an Adam Eve top or bottom? So, look, Adam and Eve, it just sounds fancy. So a top would be, if you had one attempt there, and then you go up, and then, you make multiple, attempts at the same top. And so this would be effectively an Adam and Eve top, where this is so the Adam is just the single, and the Eve is the multiple. And it could be the other way around. So to me, it looks like Tesla has made an Eve and Adam double top. I think, if I remember right. No, maybe it's an Adam and Eve, whatever. And Tesla is another thing where we see 2 patterns in conflict with each other. And I'll talk about that. Where earlier this week I was short, and then, I could see that it was an area that wasn't working. I got out of my short. I probably should have gotten long. But, this is where the confusion. And so, sometimes I just need to wait until something settles so that I can understand where the risk and reward is. And to me, it's always, about waiting till it closes. And so really what this was right here, and I said at the time, at the night that I told you I bought it, I explained that this was a coil where, all of these price bars effectively sat within the range of this bar right there. So this thing was just building energy. And the more energy it was building, I always kind of, make the analogy to getting your hand, putting it on top of a beach ball, pushing it further and further underwater. And then you let your hand off, what happens? It just uncoils, and the energy uncoils. And that's what the markets are. The markets are energy. They're storing of energy and releasing energy. And that, I think of the markets as energy, right? So this is energy. This is like a rounding top, and you have this coil. You have this building, you can feel it. It's just all this pressure, and then boom, it just uncorks. So the more, pressure you build, and then it will uncork in the direction of the trend and the pattern. And so, that's what I look at, markets as energy. So I always say, markets sell off, they build energy so they can sell off again. Does anybody have any questions on PayPal? So Sun says, is it safer to take the trade once the latest lower high is broken? So not really understanding that question. So what I look for is, once I kind of feel like I understand the pattern and the direction, then I look for a bar or a set of bars where I can create the risk reward circumstance. The problem now is that, PayPal has gone from 95 to 112. So it's gone up 15% in 3 days. So, now getting in is a different proposition than when I got in. So when I got in, you can see there was this coil and, this one bar where effectively this was an inside bar, where this bar effectively sat within that bar. And then by virtue of it being a very narrow range day, my risk was by definition low. So I basically bought it right here in the aftermarket at $100.50. And in my mind, my risk was that low, which was about $4 lower. Now you're up, $15 from there. So if you get in here, it's, the risk reward calculation is not as clear. Although I think that this is just starting. I think effectively by coming up here, we're right at what's called the neckline. And when the market goes through the neckline, then, it effectively confirms. Now, this is tricky. This is just a counter trend. It's bear market. I don't know how long it'll last. So I got in a good area. And if it comes out tomorrow, start getting closer to 120, I'm going to start shaving some of my position off. So to me, this is very much a trading environment where typically I'm looking for, much bigger moves. And this could very easily go to 130 or 150 or what have you. And and then I start looking for, where the obstacles are in the trade. And, again, this gets into the nuance, but there's, kind of a key reversal there at 130 and then another one there. So the first real obstacle in this trade is going to be, up here in the high 120s. So there's still a good chunk of change, I think, on the table here to be had in PayPal. But really what I'm trying to show you is just a setup where I can, I try and understand what's going on, try and look at the pattern. And so people will say, well, you've got it, the trend's your friend, you got to trade with the trend. And so this has been a downtrend, but trends do change. And just like Uber, when they change, they put on a pattern that indicates a change of direction. So now, once this thing gets going, you could kind of, maybe wait, gets going, and then, comes down, and then maybe you kind of has a retest, and then it has a key reversal, and then, you could buy it here and put your stop there and, catch it like that. So basically what I do is try and understand what is going to be the next direction. 100 to 130, 130 to 90, where I can take a piece, 10, $15 out of the middle of that move. And so I just look for, what I call my key reversals or my inside day bars, and then create risk reward relationships. So Natalia says, yes, you detected the double bottom, the inside day bar coil, hence you establish a risk reward long, very explicit, thank you. So yeah, Natalia, thank you for that feedback, because, I don't know, if I'm explaining this well enough to, for this to come across in a way that is understandable. It's very nuanced and it's very muddled, because on one hand, we talk about the indexes and, all of the, but it always comes down to finding an area. And to my mind, you can see that Uber, PayPal, these were areas where, I just got it, where the risk reward was so small that even if I buy it there and, this thing, goes down from here and blasts through here, I lose $4 and, so what? I'll make a lot more if I'm right on the upside. And that's the whole idea. So the idea is not to be right all the time. It's just the quality of your trades. So your winners should be much bigger than your losers. And that way you'll always be a profitable trader. People really don't understand that. If you set up your trades with a 3-to-1 risk reward, and I talked about this on, when I put this trade on, if you take a $4 risk and you get a $12 move, that's a 3-to-1 risk reward. Means your outcome is 3 times bigger than your risk. And if you can do that, you can actually lose 72% of your trades. So this game is not about winning on every trade. But if you're, playing the FX game and you're, trading for 7 pips or 10 pips and you're trying to do this 5 times a day, where you're trying to make 10 pips and you've got to, you're trying to make 10 pips and you obviously have to risk 10 pips. Now you have a 1-to-1 relationship. Then you have the spread that you have to pay the broker. And this is why you've got to win 90% of your trades. And if you do that 5 times a day in and out, there's just no way you're going to be correct 90% of the time. And this is why most people are losing, because they don't really understand. It's not about how many trades you win. I could lose 5 out of 6 trades. And, I had 1 trade last year that made up for all of my losers. So it's about the quality of the wins. So I talked about what? FedEx. I'm also in FedEx. Let me just see what's doing. FedEx was announced earnings, and it's a little bit down in the aftermarket. So I bought some FedEx, and it's slightly down. It's down about $3-4 in the aftermarket, and is probably a little bit extended. I probably should have known better. It's pretty extended for the weekly, but it looks like there was an area. So on one hand, what I see, this is, very bearish looking chart. On the other hand, and this is what's, this is where the short times and the long time frames kind of come a little bit in conflict with each other. And this is why it's somewhat difficult to explain. So if I look at FedEx, I could argue, and, this looks very much like a double top and a head and shoulders. In fact, there was a head and shoulders in here too. And these are very bearish price patterns, right? And, this whole thing was connected by this kind of common neckline. You can see how amazingly it just intersected there, and then it caught a bid here, and then, it's gone the other way. So what I try and do is look at the pattern. And so this is, to me, is a giant head and shoulders, which is a very bearish price pattern. And it, suggests that prices should go that way. But you can see that prices didn't go that way. They kind of hit here and are going the other way. Now, it could still turn here. And, if it kind of reconnects back here, then, it'll be game on, and I'll very much look to short it. But just the way this thing caught a bid in here, where you can see that made a new low, close on the high, made a new low, close on the high. And so you've got this now double bottom here. And so this is the conflict you run into, where you see all of these bear price patterns, then all of a sudden the market comes down here and, does a little support, and, now it's the other way. And so this is the dynamism of the market. So, you can go to textbooks and say, wow, here's a double top, and then, you see it all played out, and that looks all well and good. But in reality, you've got to see. So what I do is I draw my structure. So I draw this and I look at this and I go, okay, this is inherently a bear price pattern. And if I'm correct, this is what prices should be doing. But if prices aren't doing that, then I'll basically just do the other thing, because it's not doing what it should be doing. It's starting to bust the implications. So we see these patterns, and then what I do is I surrender and watch how does the market observe or play within these patterns. And, if the market's not playing nice and going where it should, it's going to do the other thing. And so it was kind of on that basis that, I kind of bought something that, basically looked pretty ugly. And then this was also like kind of Bank of America and all of these kind of things where you had these short-term, you had these patterns, and sometimes the patterns will do their job. The short-term pattern will do its job, where you see this huge double top, and then you could have had a huge trade out of that. So again, what I'm trying to do is see a pattern and take a piece out of the middle out of that move. And then what happened was the long-term trend kicks in, and now you've kind of got this inverted head and shoulders, and now it seems to be going the other way. But, a lot of these things, like Bank of America, like I showed you, come in, and I mean, the intersect is just amazing. This was a bit of so this is a bear trap where it snuck a little bit out of this trend line. And, people got all excited here. And then, if you didn't get out, it's right in your face. So it's a trap. And when these traps are sprung, they usually go the other way pretty quickly. So now this kind of looks like an upside down looking inverted head and shoulders. So these markets are, showing you one pattern, then showing you another. And we got to sort out, what it all means. And to my mind, this is just very much a trading environment. So typically, I look to put on trades and go for a ride. And now, if this thing gives me a 1-3 day ride, a bump, I'm going to take it out, reload, look for the next one. So, I don't like to, lead you to believe that I'm just an in and out day trader, whatever. But you got to basically take what the market environment, the market environment now is fluid. These indexes are going up and down 1% an hour. And so I'm just trying to take chunks and try to create these risk reward relationships. And, several times a year, you'll see a big setup that corresponds to a big move. And I'll put a bet on, I'll put, calls on or puts on or what have you, and look to go for a ride on, a big bet. Ken says, during these uncertain times, do you try and stay flat over the weekend? I don't really look at time. I look at price. Well, markets are a function of time and price. So I shouldn't really say that. But, I'm in this dollar yen trade. I have been for a while. Actually, I got long on Sunday. But no, I don't really worry about weekends. If I'm in a position and the position still looks good, the market doesn't know that there's weekends here. It's still going to do what it's going to do. So to my mind, weekends or news should only just be a catalyst to send the trade in the direction that's indicated by the trend or the pattern. And so, here you kind of have this thing where, this is where, so sometimes markets will rally to their breakout area and then fail again. Although, this kind of looks like there is a lot of support in here. So I realize I kind of have struggled for a cogent message this week. And I don't know if, what I'm trying to say is clear, but really, because the markets have just shifted direction so much. But basically, it's, I open any chart and try and understand, what is going on that chart. Now, I think there's, an interesting opportunity in these yen pairs. A real opportunity. So this is the euro versus the Japanese yen. I'm not sure why it went so funky. So this is the euro versus the Japanese yen. And, sometimes it, takes months and sometimes years, and I think we're on the cusp of an enormous opportunity. This is a long-term trend going back to, 2007 in the euro versus the Japanese yen. Now, it could be something or nothing, but you can see that the euro versus the yen has been coiled in this very long-term symmetrical triangle. It's just amazing when you connect the highs and you connect the lows. If you had an architect come, you probably couldn't, draw this, triangle, any better. I mean, this is perfectly symmetrical. And it's taken 12 years of random, financial events and wars and all this stuff, and yet there's still a pattern. And this is, why I just love the patterns of the market. It's just amazing how they come together despite everything. And so what we see here is, a pattern of lower highs over the last, several years. And then all of a sudden you start seeing the patterns break. All of a sudden we're starting to see higher highs. And now, again, these certain markers, certain price bars. Now remember, this is a 1 month chart. Every one of these bars represents 1 month in time. And, the market points in the direction it wants to go. When you see a reversal like this, and we'll have to see how it closes, makes a new low and then close on the high, this is kind of pointing in the direction it wants to go. You can see that there was a double bottom right at the base of this symmetrical triangle, but here was this reversal that started it all off. So made a low right on the cusp of this triangle, closed on the high, and this guy is pointing to where this market wants to go. And so, we're just, we kind of broken above this thing and we've been hanging out here. But, if we start making progress and start making new highs, you could just see an amazing move. Maybe these things come along once every 10 years. And, we could be on the cusp of that. So by looking at these long-term charts and understanding, what I'm trying to understand from a global level is, what is the pattern that is directing traffic for any given time? So what I'll do is I'll look at a pattern here and I'll see this head and shoulders. And then I'll come back to the weekly chart or the daily chart to try and refine my trade. So once I kind of understand what's going on here and that we're likely to go lower out of here, I'll then toggle between the different time frames to set up my trade. And then you had another double top right here. And then you went for another ride on the downside there. And then you had, and so, this gives you an appreciation how, sometimes one pattern then gives way to the other pattern, and the market is inherently fluid. So, that's why it's very difficult to do this, because I might say, well, I'm buying Uber today and 2 days later I'm short Uber, and you go, well, what was that all about? So the markets, give you different looks, and then, some are, more influential than others. And frankly, there was a double bottom all the way down here that told you that the breakout was likely to be on the upside. So this guy all the way back in 2012 was pointing to where this thing was going to go, which is just amazing to me. So this, is kind of, you got this reverse triangle here. And if you blow this out, this thing could just be just an enormous move. So again, what I've been trying to do is, share with you how to analyze charts. I don't care if it's Uber or, it doesn't matter. Corn, wheat, natural gas, gold. To me, I just look at everything through the prism of prices, patterns, trends. And so, markets are either in trends, and this has had obviously no clear trend for many years. So sometimes it becomes more difficult. And then, those, type of things, you don't want to play in markets like this. This is where you just get cut up. And most people, look at these markets and try and get in and out 10 times a day. And, 3 months later, you're wiped out. What I try and do is let all of this sort itself out, buy it here and let it, and then sit in this trade. I could sit in this trade for a year. I have sat in trades for a year. So to my mind, that's what I look for. I look at patterns that lead to moves. And they don't happen every day. They don't happen every week. And this has been kind of a difficult week because, there have been so many countervailing themes and sub-themes and moves and, and sub-moves. But it doesn't matter. It all comes down to a justifiable trade with a risk-reward parameter. And so once I kind of understand, see a pattern, so we've, looked at the monthlies and what have you. So now you've kind of got this kind of reverse triangle, and in and of itself doesn't really mean anything. And I would just put a buy stop here next week and let the market confirm me. So, next week it opens and goes back lower, no harm, no foul. On the other hand, if it opens, comes back and hits your buy stop, you could be into a good trade. And this way you don't have to watch the markets, for, until your eyes bleed till midnight. You just put a resting order right there, or, above this whole thing, even better. Or even two, if you're aggressive, you could buy it here and then on a new high, and, it should, keep going. There's going to be, the next resistance is about 137. So Sun says you'll go from the monthly to the weekly trade on the daily. Yeah. So what I will do is then, once I kind of understand what I'm looking at on the bigger time frame, then I'll just, kind of peel it back to an area where I can kind of, maybe, so I would set it up on that. Obviously when you look at it now on the daily, it's kind of look like it's already happening and you're a little bit scared to take this trade. But to my mind, this thing's just, is going to keep going higher. I mean, when I look at this on a daily, what it looks like to me is just this funky, I can see the, reverse triangle. And then, on the shorter term, I can see this inverted head and shoulders, which kind of, you could say the neckline was there, or, it's somewhat arbitrary at this point. But, this feels like it's just going to keep going higher, and it looks very scary to buy it there. The only problem is, ascertaining your risk. It's just kind of gone straight up, but I can't see that there's a whole lot of risk buying it here. Even if it were to come up, markets don't just go straight up and then, go straight down like that. It's just not going to happen. So if this thing kept coming off, I would actually just look at it as a buying opportunity. I just keep buying more. You may even get a symmetry here where maybe it comes down and matches this and then goes back up. But I would be buying this all the way down here. So yeah, or you could go to the weekly and set up a trade on the weekly where you could put just a buy stop above this, this bar this week's bar. I mean, it looks very thrusty, and typically I don't like to chase momentum, but this is a thing that looks like it, if it takes out 133, it could blow the roof off and go for one of these once in a decade moves. So, where you place your stop loss is really pretty arbitrary. I mean, it's arbitrary. Anywhere you pick here is just arbitrary. What I like to do is find trades where I can dial in my risk, where I can understand that it's very small. But here, I would just take a small position and close my eyes. And my attitude would be, if this thing came lower, I'd keep buying it. Because I don't see how the market then is going to sell off through all of this. So at some point, I would just keep buying on the way down, which is not the greatest way to trade. But, certain times I will look to accumulate a position. So do you take volatility? So, Gio, I look at everything. I do. I do look at the VIX, and, basically anytime the VIX gets above, 35, it's very dangerous to be short. So you can see the VIX went to 40, which meant that it was very dangerous to be short this market. And now you have all of these, huge moves higher. And, this is where, the VIX gets, into, a very overbought territory, and tells you that it's a very dangerous place to be short up there. So yes, I look at a lot of things, but, again, to me, it just, I can dial it down to risk and reward. Like PayPal, Square kind of looks like, you've got these two reversals here on the weekly basis. This is SQ, called block now, I guess. So I can see the double bottom appearing on the weekly, and then on the daily, I can start, making a case that this thing looks like it's creating a bottom down here, where, it had this trap where you can see it. So this was a nice bear trap where anybody chasing it to those lows is now stuck and steaming. And if, you don't get out, this thing's going to turn the other way pretty quickly. So this is Square, where, looks like it's made a nice kind of inverted head and shoulders. Here's a double bottom. And now you're about to, break through this neckline. So there's a whole bunch of stocks that look like they're just going to have these kind of relief rallies. And so this is what I look for. I look for patterns in the market, and then I look for, opportunities where I can dial in my risk. And the thing is, this has already gone from whatever, 90 to 130. So it's already had a pretty good move. So if you try and buy it here, it may just come off. So what I try and do is wait for a time where, it does a coil or does something where, there's a kind of an inside bar or something like that. And then I can put a buy stop here and a sell stop there and create a risk reward relationship. All right. So, yeah, Andrew says, yes. So typically when the VIX is above 35, just start covering your shorts. Sun says, is it wise to go into the 1 hour chart? Nope, I would not. So to my mind, why, everybody's losing their money in trading. And, we could talk a lot about whys. And I think the whys are, most people are looking at short-term chart patterns, 15-minute, 5-minute, 1 hour, 4 hour. But you don't really see enough history. This is a daily chart. And frankly, for me, I can't really even understand enough history here. So I would either put more daily bars or a weekly to kind of, get everything in context. Sometimes I can just look at a very small prism and understand a risk reward relationship. But, by drilling it down to shorter and shorter timeframes, what's happening is that you're trading more. It just invites more. First off, you can't see the entire picture. You can't see a global view. I just showed you a euro yen chart that goes back to 2007. So now most people are kind of trading on a 1 hour chart or a 15-minute chart, and they're seeing the last 3 days. And I'm trying to understand it through the prism of the last 12 years. And so, if you don't really understand the cards you're holding, then you're hostage. You see a double bottom, on a 1 hour, it looks like something you get long, and then all of a sudden it's down. You don't understand why. And then you look, at a weekly chart, and you can understand that so there's all kinds of reasons, but I think it comes down to a choice. We all enjoy trading. It's exciting. It's a blast. We like the rush. It's, easy to kind of chase the next shiny object. And that's all fine and well if you want to just, have some fun money, blow through it every 3 months, refill it. And that's basically what most people are doing. But, if you're looking at making serious money in the market, then, it comes down to certain behaviors. And to my mind, I either buy right at the beginning or right at the close. I want to see how a market closes relative to its low. And I don't know that until it closes. In between, and I showed you yesterday, Coinbase went up and down and sideways and then finished on the high of the day. So how it finished really showed me a lot. And so that's not really exciting. We're maybe, trading, every couple of days, or we're looking for a setup that takes a while. So this has been in a kind of a sideways bottoming pattern for weeks and weeks and weeks. And, it just took until this time period now to kind of start revealing that, maybe there was an opportunity. And so, you really have to ask yourself, what is it that you're looking for out of your trading? And, most people would say, I want to make money. But if you look at their behavior, it's counter to what is going to make you money. So, what is going to make you money is identifying patterns that lead to broad moves and then taking a piece out of this. So when this went from 223 to 150, and you could trade 30, 50, $70 out of a market, that's how you make money in the market. You don't kind of pull up your armchair and try and trade a 15-minute chart on one bar and try and get in and out of this bar 5 times during that day, because over time it's just going to grind you down. So what I try and do is wait for times like this. And for the last 3-4 months, it's just been an absolute feast. But for the last several weeks, it's been difficult. So, in these periods, I kind of turn more into a trader where I'm just looking for these, 3-day bursts. But these can be very healthy. I think, these counter trend moves can be, very healthy. So Sun says, when is a good idea to take twin trades or even triple trades? So I don't know if you mean triple your risk or add to your trade. So if something is, working and I see that, that I'm in a trend, I will look to add to my trade. So, key reversal goes, it gets into another area. So I will look to add to my positions. When is it good to take bigger risk? I don't know if that's what your question is. It's times when markets get drilled into certain areas. And, let's say that there was a little, inside bar here yesterday or tomorrow. And then, Monday I come in and I see I can kind of buy it here and take a $3 risk. Then I might take a bigger size position just because my risk is going to be by definition pretty small, to, what I perceive as the reward. So there are certain times when the market backs up where I literally feel like there is no risk. Now this is, this has gone up from 90 to 130. So, could it come down, $5, $10, and still go up? Yes. So the risk is a little bit different here than it was, when this came out of the gate there. So when I kind of find these little areas, like maybe Uber today, where I can just, in my mind, take almost no risk, then I will take bigger positions. Gio says, your strategy seems to suit well in trading markets. What about ranging markets? So again, this is a ranging market, and I will take pieces out of the middle, out of a PayPal or there's always something. The question that I ask myself is, what is my objective on this trade? And my objective is usually a function of the pattern and then the size of the pattern. So to me, this is the euro yen. If I look at this weekly chart, and I remember looking at this and saying, this is a double bottom. And it's a big bottom. So if I see that, you've got a pretty good base, it then stands the chance that you're going to have a pretty good move out of that. So my trading objectives and my horizon is really a function of what I see going on at the market at the time. And, how much of a move is likely to occur. Now, the difficulty of these markets is that on one hand, I think long-term, we're still going to probably make new lows. Short-term, we're going to have these counter trend things. So I'm just trying to take a piece of these things as they come out of these little coiled areas. So my objectives at different times depend on where the market environment is. But there's always a risk reward. in non-trending environments, in trending environments. You can see PayPal went from whatever, 100 to 112 today. It's a 12% move in 3 days. So Joseph says it's easy to do when you have sufficient funds to buy and hold longer. So again, I always feel like there's this misconception of when I tell people, that I'm looking to take big moves, people always feel like they need to have big money in order to do that. And, I showed you how to use that tool to, assess your risk. But effectively, a 1% risk on a $2,500 account, or, call it, whatever, a 1% risk on a $1,000 account is the same as a 1% risk on a $10,000 account, is the same as a 1% risk on a $100,000 account. It's 1%. So I always feel like there's this notion that people feel, well, I can't do this because I don't have a big account. It just comes down to, position sizing. So basically, you're just trying to take a bet where you're going to risk, 1 or 2% of this account, take a $20 bet, or, a $200 bet, or a $2,000 bet, and, start getting this thing on, and you can always add to your trades. And so, Joseph, I think it's it's a myth that you need to have a big account to take advantage of big moves. And in fact, I would argue, well, first off, I would argue that day trading is just a road to nowhere. And you don't have to believe me, just look at the industry statistics, right? 90% of people certainly in the FX market are estimated to lose their money in the first 3 months. I think it's a little higher than 90%. Why? Because they're trading in and out 5 times a day. And by definition, your objectives are too small. If you're trying to, trade for 7 pips or 10 pips or 15 pips, I've had people on my review website tell me, Mark, before I met you, I never took 100 pips out of a trade. Now, I don't get into a trade unless I can see my way to make 150 pips. Because I'm always looking for a 3-to-1. So I'm always looking to risk 50 pips. And so if I don't see a trajectory where I can see a pathway where I'm going to make 150 pips, then I don't do it. But what most people are doing is they're pulling up and they're, trying to trade this bar 5 times a day, trying to get 6 pips here, 10 pips there, 11 pips there, whatever. And that's just, a road to. So what I'm trying to do is understand big picture. What is going on big picture? So once I understand that this thing is bottomed, then I'm likely to see a move that goes from 123 to 134, and that's 1,100 pips. And if I can take 500 pips out of the middle of this, that's what I'm looking to do. Now, does this happen every day, every week? No. But if you do this, this is how you make money over time. All right, so listen, I want to thank you guys for hanging out with me for the last 4 days. I hope that this has been somewhat instructive. I realize at some point I've searched for a coherent message, but to me, ultimately, it comes down to patterns and price action. So to me, just looking at this weekly, I can see this double bottom, which tells me that this market is going to head higher. Then we have this kind of intermediate pattern, this reverse triangle, and then you have this price action here where it made a new low and closed on the high, this massive key reversal. And these reversals point in the direction they want to go within the context of the pattern and the trend. So once you kind of understand what is the pattern, and the pattern could be 3 months ago or 3 years ago, that's, this is governing whatever is happening now. So whatever this did in this time frame, is going to dictate how this goes. And so it comes down to understanding the patterns, but then the market gives you a whole bunch of, misdirect, where it's going up, but then, look, for weeks and weeks, it also went nowhere and down. So, I always say the market's kind of like a magician. It doesn't reveal its intentions right away. It does reveal what you should be doing here. And then it gives you all kinds of, stress where you lose all your money and then it goes in its intended direction. So this is kind of the art of trading, is kind of determining what is the trend or the pattern that is governing the direction. And then once you understand that, you can understand that these kind of sell-offs are actually opportunities. So what I would love you guys to do is, I know you're always asked to, give reviews and whatnot. I'm going to put this link in the chat box, and I would really like to know what you thought of this week's webinar. It would be very helpful to me. Don't put just negative comments or good comments. Use your words. And this is also a way where you can go and see what others, have said. If you're considering joining the Pattern Trader family, any one of our products, you will get an email after this webinar today, inviting you to, join the elite program. We don't take everybody, and it's not something you just sign up over a link. One of our team members will talk to you and, explain everything that's involved. So basically, if you come to this website and, hit write a review, I would very much appreciate it. So Andrew said this week's webinar was awesome. Orlando says you're very knowledgeable, so thank you. Vic says, Peter, you're welcome. Mark, Linda says amazing insight. Vic says well worth attending. So if you want to know about our other programs, Yvonne, you can just message our support team at the Pattern Trader, or you can, check out our website, thepatterntrader.com, to see what else you may be interested in. But again, would you guys say that you could see the value of using this information, patterns and price action? Do you think that you could see it make a difference in your trading, or was it, complete Chinese to you? So, I understand if you got lost, because I don't think I did a very good job this week. So Rashid says yes. Joseph says yes, yes. Shower says you are the master. I don't know about that, but thank you. Vic says absolutely clear. Yvain, yes. So Howard says absolutely, makes a great deal of sense. So yeah, it all comes down to a picture. Picture's worth 1,000 words. What Jerome Powell says, the Ukraine war, oil shocks, on and on. I'm looking at the euro versus the yen and trying to make an objective risk reward calculation. And that's what trading, should be all about. But instead, we let all of these external filters come in. And the idea is to be just ruthlessly objective. So you should be able to open up a chart like this. It doesn't matter if it's a euro yen, in fact, you should even just take the name off. You should be able to look at this chart. I don't care if it was in IBM or corn. I would look at it through the same prism and make the same decisions. And all right, Carl, son, you are welcome. So thanks a lot, guys. Hopefully I'll see you on the other side very soon. And thanks a ton. Dwight, thank you very much.
No problem, Mark.
Thanks, buddy. I appreciate it.
Absolutely.
Thanks.